Hello and a warm welcome to our very first episode of Porfolio Watch, a show that looks to improve your understanding of investments and guide you in making smart money decisions. I'm Gugulethu Mfuphi, and tonight we take a look at the theme of global synchronization. Now, the global economy has been described as going through a Goldilocks phase. It's not too hot, it's not too cold, it's just right. Now, things are certainly looking up for the global economy. Better growth since the global financial crisis is seeing the US likely to continue with its rate increases. Japan has been keeping a low profile but doing very well with Abenomics, and China and India are still the powerhouse economies of emerging markets. But what are the factors that are supporting all of these dynamics? Well, joining me on the desk to dissect all of these factors is Andrew Dittberner, Chief Investment Officer at Old Mutual Wealth Private Client Securities, and Chris Gilmour, Independent Investment Analyst, but we popularly refer to him as Koko on this show. Gentlemen, welcome and thank you so much for making time. Let's actually pick up with the dynamics that we see from a global perspective, and bearing in mind that, sure, yesterday was a holiday for the markets in both the US and the UK, but overall there's this sense of positivity with regard to investments in 2018. Andrew, what is driving this?
Yeah, so I think we've seen this, fairly long-winded recovery coming out of the US. That started in 2009. It's going on to its 9th year now. Europe is also doing quite well. We actually saw Europe last year, growing at a faster rate than what the US grew at. And, Japan hasn't really been spoken about. Everyone's kind of forgotten about Japan. But they're actually doing quite well, and I'm sure we'll touch on it just now. So, if you look at your advanced economies, they all seem to be doing quite well at the moment. And it almost, leads itself to a sense of complacency. I think if you look around what's happening from an investment point of view, people seem to think that markets are just going to keep going up and up and up. And whilst, the global recovery has undoubtedly supported corporate earnings, which in the long run we know supports stock markets, it's not going to go on forever. But however, whilst the music's playing, let's keep enjoying it. Keep
enjoying it and keep dancing, and that's exactly what we want as investors, for the markets to keep going up and up. But of course, our expectations need to be managed. And Chris, you've seen many a cycle through the turbulence of macroeconomic pressures, whether it be political changes as well. How do you see 2016, 17 and 18 and maybe even 19 playing a role with regard to where we are with regard to that cycle? Are we part of, in the dip? Are we picking up towards the peak?
Look, I think Andrew really put his finger on there when he talked about complacency. And that's precisely what's been happening over the past couple of years now. We're in a situation where we've got low interest rates, but they're rising. And the trajectory is going to be relatively flat, but nevertheless it's rising. We've got low inflation, but it's starting to come back. Not with a vengeance, but it's starting to come back. And we've got incipient trade wars, breaking out, possibly. But I wouldn't put too much store by that. But whichever way you look at it, I think we've probably milked the best of the situation in the past few years. In other words, what I'm saying is, I think given a background of gradually rising interest rates, and the US is the best proxy for this. If we're looking at 4 interest rate rises this year, we've had 1. Maybe we're going to get another 3. I don't know.
Do you trust them, though? They so often are quite bullish on the interest rate expectations, but never really implement when it's
I suspect we are. This new Reserve Bank Governor, Jay Powell, I think he's somewhat different to his predecessor, and I think he's going to stick by it. So if that's the case, then we're going to see all other countries, bar none, raising their rates as well. Now, that's not necessarily a conducive background to a buoyant equity market. So to answer your question, I think the likelihood is, and again following on from Andrew's point, 9 years, the market's tired, it's been tired for a while. We've had the odd correction over the past couple of years. I suspect we should be braced for more corrections. I'm not necessarily saying we're going to get a meltdown, but we're not in a wonderful space. It's been good, and we are in a kind of Goldilocks space, I agree. But I think it's only going to get progressively worse. I don't see the really good stuff coming out. That's what bothers me.
Andrew, what do you make of Europe? Because we've obviously had quite a bit of noise there in the last couple of years. Is things seemingly quieting down, or is that the case?
Yeah, so I think, if you look from an economic recovery, where they are in the economic cycle, our view was that they were probably slightly behind the US. Going into this year, but we've seen them struggle in the early parts of this year. But I think sentiment, is still there. The labour markets are getting tighter. There's obviously some noise around, what's happening in the euro area, and I think that's causing a bit of concern, amongst investors. And we can just look at what's happening in the Italian political sphere at the moment. Brexit, now there's talk of, last year Brexit, or Britain was definitely going to exit. Now, are they going to exit or aren't they? You've got issues around Spanish politics. So there's a lot of noise around Europe at the moment, which I think is causing, some concern amongst investors. But I think from an economic recovery point of view, I think they continue on the current trajectory for the foreseeable future. Quantitative easing, I think, maybe comes in at best or soonest late this year, but probably next year. I mean, the reduction of quantitative easing, rather.
Indeed. Well, that's the US as well as the European markets, but we can't forget what's happening in Asia as well. And you touched on Japan very briefly, perhaps slipping under the radar.
Yeah, so Japan, if you look, if you go back over the past 5 years, from an economic growth point of view, they've done really well. If you look at their markets, the Nikkei has actually outperformed S&P 500 and the European market. If you look at the stocks 600 as an example. So they've done really well, but there hasn't been much fanfare. Abenomics has worked. We're looking at some reforms, particularly in their corporate sector. So corporate governance has improved materially. The labour market's looking really strong with a lot of women. There's actually if you look at the number of women that are working in the Japanese...
See what happens when you bring us to the table?
Labour market, it's more per capita than in the US, and they work into an older age. So they're looking, as an overall picture of the economy. I think Japan actually looks really, really good at the moment, and the investment community has forgotten about them. If you look at the valuations on the stock market, they're a hell of a lot cheaper than what you're going to find in the US or in Europe, with about 40% of their companies actually trade below book value at the moment. There's just the sentiment is just not there, or the positive sentiment is just not there for Japan at the moment, despite what the economy looks like.
Indeed. Well, that's naturally a conversation with regard to the macroeconomic dynamics that we see across the globe. But what does this mean for our portfolios? Let's get into talking about the equity space. Gentlemen, you did both mention that globally the global macroeconomic environment is picking up, whether we look at the US or Europe or even Asia. But what does this mean from a stock market perspective? You picked up on saying that perhaps there's some value to be found in Japanese markets. Is this a theme and a trend, though, that stands true for other major global players?
Yeah, so I think if you're looking to get exposure, to some of these markets, and we haven't touched on the emerging markets yet,
yes, we'll do.
China and India, but if you want to get exposure, one way to do that is to buy companies that derive a significant portion of their revenue from these countries. So I know we're going to talk about a couple of these companies, but that's as opposed to going directly into these countries and buying shares in those markets. You can also buy a equity that might be listed on the South African Stock Exchange that has exposure to, be it Europe, Japan, China, or whatever the case may be. So it's not a case of, we have to go and buy Chinese shares or Japanese shares to get that exposure.
Makes sense. And as South African investors who have exposure to the JSE, we're also quite lucky because we do have some South African entities with exposure to those markets, even though their earnings might be questionable of late. But let's also touch on the emerging markets segment, which you did highlight. And Chris, I'm happy for you to come in here. When we hear about this positive growth for the US, for Europe, as well as Asia, it makes me a little bit nervous as an emerging market investor, given that locally it seems as though the pressure will be on not only from the bond market space, but also our equities performance in this environment. How does that fare? Andrew, and then we'll come to you, Chris.
Yeah, so I think, your economic growth is not always correlated to your equity market.
Sure.
So your economic growth will drive corporate earnings, which in the long run is going to drive your stock market. But it's not going to happen all in the same time. So if we just think back to when Trump, got elected, we had the Trump trade, and suddenly there was sentiment around, what Trump's going to do, and we saw the stocks all, rise very quickly, and that slowly undid itself over, the next 3, 4, 5 months. And I think we've seen the same thing in South Africa with Ramaphosa, if we can call it that. So here we see a number of SA Inc. banks, etc., doing really well on the back of, Cyril Ramaphosa being elected as the president. And this is sentiment driven. This isn't, long run earnings driven. You know, maybe the earnings come through in a year or two's time, but they're not there right now. And what we've seen subsequent is that our market has actually, you know, pulled back quite significantly from those highs of, I think, December, maybe even January.
60,000 point level, right?
And we see today even, you know, the market's down quite significantly. Yeah, so it's not always, you know, directly correlated. It does take some time. But in the long run, economic growth does play through to corporate earnings, which plays through to your stock market.
Your thoughts, Chris? You agree with Andrew here?
Oh, no, I agree entirely. I just think you've got to be very selective in emerging markets at this juncture. If you go back to the global financial crisis, 2007, 2008, it was a no-brainer. Emerging markets were looking so good, so attractive. Now, many of them have taken advantage of low interest rates. They've geared themselves to the hilt. So now you've got some casualties appearing on the horizon. You've got Turkey, which raised its interest rates by, what, 300 basis points last week. Yeah. You've got Venezuela, you've got Argentina. You've got a few basket cases emerging, many more than you had a few years ago.
Sure.
So you have to be very, very selective in your choice of emerging economy. And strangely enough, and again I think following on from what Andrew was saying, South Africa, ironically, starts to look an awful lot better than many other countries, relatively speaking.
Is this because of the political changes that have taken place?
Not just the political changes, and you touched on banks, for example, Andrew. You know, our banking system is probably still the envy of the world. It emerged from the global financial crisis totally intact. It might be a bit on the boring side, but, you know, at this point in time, boring is good.
Boring is good. If that's what we have to say, then we'll certainly get some insight in a moment into some of those stocks that we need to select. I understand doing the rounds around coffee outlets and maybe some financial services offerings too. Stay with us here on Portfolio Watch. After the break, we'll give you more insight into the equity space and some stocks that you might need to add into your portfolio. Welcome back. You're still watching Portfolio Watch, where we're about to give you some insight into some key stocks that you might consider putting into your portfolio. Now, just a warning, if you're looking for some technical analysis, this is not the show for you. We're actually going to have a casual conversation about the investment insights and critical concepts around some of the stocks that we'll be unpacking in the next couple of minutes. To get back into the conversation, though, Andrew, let's pick up with you. And Visa is one of those that you've selected for us to potentially look at. And sometimes this gets confused for being a financial services company, given that it helps facilitate payments across the globe.
Yeah, so Visa's not a bank. I think that's where sometimes confusion comes in. As you said, they facilitate payments, you know, between the user, a merchant, and your bank. So you can kind of think of them as a toll booth, you know, for global payments.
Makes
they
sense.
just, you know, pick up a small fee for facilitating those transactions. So obviously it's highly geared to, you know, the number of payments that take place around the world. They've got, you know, from a network effect, they've got a massive network, you know, in over 16,000 banks, I think, are connected with, you know, billions of cards. You can imagine the network effect
Sure.
that is at play within Visa.
Quite a strong opportunity that with regard to volume as well as the number of customers and merchants that they can interact with. But what makes it a positive investment case here?
Well, I think, you know, when you see the spend that is going on, the increased spend that is going on around the world. We just came back from Hong Kong and China and the wealth, and you can see, you know, the cashless payments, you know, as you move away from, you know, paying with money to paying with cards. I think that's going to be a massive driver, and you could see it out in Asia, that people don't pay with cash anymore, they pay with cards. We saw it in India, was it last year or the year before, when Modi, you know, went and Prime Minister Modi went and, you know, overnight said, right, we're moving to a cashless society, and removed a whole bunch of the bigger notes in that economy to force people to use cards. That plays right into Visa's hands. And as we talk about this global synchronized growth, you know, that also volumes and number of payments are going to increase as the global economy continues to grow, and driven obviously predominantly by these powerhouse emerging markets, China, India, etc.
To wrap up on Visa very briefly, given that we do live in a digital age where mobile money is also picking up on the African continent and across the globe, digital currencies, cryptocurrencies, should we be concerned about some of these risks here? Andrew?
So Yeah, I mean, there has been noise around these companies being disrupted. Visa, its obvious competitor is MasterCard, and being disrupted by the blockchain technology and cryptocurrencies, etc. And whilst, you know, PayPal, Apple Pay, there's a number of them out there, but what we are actually seeing is that a number of them are partnering with Visa and MasterCard to facilitate the payments. And also, you know, these PayPals, Google, Apple Pay, etc., they are very close to the consumers, but how close are they actually to the financial institutions? And I think that's where, you know, Visa is obviously very close to the financial institutions, and hence I think are protected, I suppose, by what we would call an economic moat due to this network effect that they have here.
One that we'll be doing our research on and maybe considering adding to our portfolios. Another company, though, whether they make a simple cappuccino, latte, or frappuccino. Chris, I understand you've indulged in quite a few Starbucks offerings across the globe. Does it actually make its way into your portfolio, and are there some fundamentally strong investment benefits here?
Google, I think there probably are. But having said that, I think in many of the jurisdictions in which it currently operates, and notably in the developed world, it may be reaching saturation. The big payoff for Starbucks is in the developing world, and notably in China. So, and I've forgotten the exact statistic, but I think your average Chinese drinks half a cup of coffee a year, right? So while they're opening 500 or 1,000 new Starbucks in China every year, it's going to be a volume game, in the sense that they've got to try and persuade people who innately prefer tea, you know, the expression all the tea in China, to actually switch to coffee. It is no easy task, but that's really, it's embedded in their DNA. They've done it in so many other countries in the world. So I think that presents a huge opportunity for Starbucks. As I say, tempered with, I think, the realization that in many other parts of the world, in the developed world, it is probably reaching some sort of saturation.
So still more opportunities maybe in emerging markets like here in South Africa? I recall when the Rosebank store opened, the queues that were outside there, again proving that there is still a significant amount of demand. Yeah,
so I think so. And I think if we look at what they did in Japan, for instance, you know, how they went into a nation of tea drinkers there and managed to move them across, and it's been a big success in Japan. So I think they'll be able to do that, you know, cross that bridge in China as well. But if you just think about the number of stores and listening to what management say, that they want China to be, you know, the biggest contributor to revenue over the next 5 years, they're opening a store every 18 hours in China, a new Starbucks store open. So if you think of the fanfare that took place here, you can imagine that it's happening every 18 hours. So they want to open between 500 and 600 stores per year in China over the next 5 years, which I think is huge. Then alongside that, they've also moved, you know, we immediately think of Starbucks and we jump to coffee. They also now sell, you know, a range of products, you know, from meals that you can go and buy in your supermarkets. You actually see some of them in the supermarkets here. So it's not just coffee anymore. You know, it's a multi-product, multi-channel business now that I think also plays into their hands.
Indeed. Well, that's Starbucks as well as Visa that we have in the kitty so far. But what about Nike? Well known for their supply of athletic apparel and also partnering with some superstars in the sports arena. But I understand they're moving away from that slightly to actually partnering with some digital retailers like Amazon. Is this a keen one for you, Chris, that you keep in your portfolio? Yeah,
look, I mean, it's expensive, make no mistake, in terms of valuation. But having said that, I think there's a huge amount of inbuilt traction in this one over a number of years. As you say, it's not just into cheap and nasty footwear made in the Far East and they bring it up and put a label on it and sell it for a huge increase. This is a company that's been very, very clever over a number of decades now. As you say, partnering with technology companies in a variety of senses. So for example, if you go for a run these days, you can go and take the little Nike app and whack it onto your watch or your phone or whatever and get all sorts of readouts here. So I think it resonates with an awful lot of people, not just in the actual product, but in the ability to get healthier. And I think again, particularly in the developed world, this is where an awful lot of their opportunities are going to come from. And I think, contrary to what I said about Starbucks, I think Nike has still got an awful lot more traction left in the developed world.
Wow. Even with the amount of market and brand awareness that it has, and as you mentioned, the expenses on, or rather the cost of the actual stock, how does it also fare against its competitors? You've got Under Armour as well in the US, you've got Adidas and a few other competitors. Is this still one to stick with and just do it?
Yeah, so so I think it still is the world's leading apparel and footwear brand, and we know that apparel and footwear is highly correlated to the economic cycle. So they did go through a bit of a rough patch where they lost some ground, I think, to Adidas over the last year or two, but I think that's behind them now. As we mentioned, they're moving, they've been innovative, they're moving to, straight to the customer, selling online. You mentioned the partnership with Amazon. So previously, if you bought Nike through Amazon, it was through a retailer. Now they're selling directly from Nike. Mm-hmm. You can also go online and design your own shoe. So they're becoming, a lot closer to their customer. Selling directly to their customer now, which obviously improves their margins as well, reduces costs, and developing a large number of their own Nike stores. So I think there still is a lot of runway left for this one.
Positive outlook on Nike. Let's talk about one that impacts a lot of South African portfolios, Richemont, given that it is in the JSE Top 40 Index and of course easy for many South Africans to access. Is there still growth and opportunities in this one? I do recall at least 3 years ago they did experience some pressures not only in Asia but of course in the European market as well with softer sales. Are things looking up here, Chris?
I think they probably are. I mean, this has been a serial underperformer on the JSE for quite some time. And, at long last, they're taking some decisive action. They're taking, I think I've forgotten the brand that they took first of all, then they took Cartier. And they physically took back these and got rid of them, their watches. Now, they didn't go in for a wholesale economic vandalism here. They just deconstructed the watches and then put them back in and recycled them. So by doing that, you're taking them out of the hands of third-party operators that might flood the market and keep the prices down. So I think, as I say, it's quite decisive action from this company. We've also seen they're taking out the remainder of Yux, or should I say Net-a-Porter. And, I think they are starting to do the right things. It's in the right space, in a global economy that is gradually improving, as we alluded to earlier. People are getting wealthier. They have got a fantastic product range, absolutely, no doubt about it. And I think the Swiss watch market, although it's taken a lot of strain recently, from your Fitbits and your Samsungs and your Apples and stuff like that, that may be a transitory thing. The kind of watches that these guys go in for are in a somewhat more elevated portion of the market. So even there, I think there's room for improvement. So yes, I think it's gradually going to improve, but as I say, track record has been so utterly abysmal for quite a number of years. There's a bit of a sentiment problem with this one.
Sure. Speaks again to the long-term strategy with regard to deploying your capital and being patient with your investments. Your thoughts on Richemont and the opportunities that lie ahead? Still some growth within the consumer segment in Asia?
Yeah, so Richemont's been around for obviously a hell of a long time, which I think talks to its ability to stay on top of things, stay with trends, which is important from a luxury brand perspective. Chris touched on the Yux Net-a-Porter, that acquisition, and I think that now moves into online sales. We've seen them recently. I think the watch name is Balm, something similar, something like that. That is a cheaper watch that that talks more to your millennials. So I think they're moving probably slightly down, away from your very high net worth watches that cost, hundreds of thousands of rand to something more affordable for your millennial purchaser. When I look at China, the growth that could potentially come from there, China remains, despite the growth that we've seen it go through over the past decade or so, and being the second biggest economy, it still remains a very poor country if you look at it from a per capita point of view. But they are growing quite quickly from a per capita point of view. So I think there is still, significant growth opportunities for Richemont coming from China or Asia Pacific, particularly. I think India is probably, 13 to 15 years behind China.
Wow.
So I think India will, in years to come, also provide a significant growth driver for Richemont.
Indeed. So, yeah. Well, that's how we wrap up the show today. And a big thank you once more to my guests, Chris Gilmour, Independent Investment Analyst, and Andrew Dittberner from Old Mutual Private Client Securities, joining us to share their input on tonight's show. Now, remember that we want to hear from you, and if you have any critical investment questions, email them to portfoliowatch@abn360.com or tweet us at CNBC Africa using the hashtag #PortfolioWatch. Join me again next week at the same time, where we look at the dangers that lurk when we lose sight of the basic investment principles. Until next week, it's goodbye from me and the team.